Michael Burry warns of the next great market crash. Don't get all in ever. As the old saying goes, there are two definitions in life, death and taxes. To that, we might be justified in adding a third, market crashes. Market crashes have been around for as long as the stock market itself, and every time they happen, they make new winners and new losers. This doesn't happen randomly, though. Though market crashes are in themselves unpredictable, it's possible to prepare for them. There are several tried and tested methods for protecting your 401k from stock market crashes, for instance, and even some that are used with mixed success to take advantage of stock market crashes. Welcome back to Investor Secrets. Today we're going to talk all about the next great market crash predicted by Michael Burry. So watch the video till the end, because today's video is going to be the bomb. Now let's get to our topic. The single most important way in which you can prepare for a stock market crash is to make sure that your investment portfolio is as diverse as possible. Having a diversified portfolio is good advice at any time, because this reduces your exposure to risk. However, during normal times, you may choose to purposefully expose your investments to increased risk in order to realize larger returns. That means that at these times, most active investors will hold their portfolio as individual stocks, stock mutual funds, or exchange-traded funds, ETFs. If you see a crisis looming, it's important to be able to move a good proportion of that money into safer investments. That can include pulling the money out of the stock market altogether and keeping it in a high-interest savings account. But it should also mean that you diversify the types of assets you hold as much as possible. Ideally, your assets should include all of the major stores of value available to you: stocks, bonds, cash, real estate, derivatives, cash value life insurance, annuities, and precious metals. The key here is to strike a balance between long-term investment and flexibility. While the highest returns can generally be realized by keeping your money in a particular investment for a long time, you shouldn't let this get in the way of your flexibility. A second strategy for dealing with stock market crashes is to have an exit strategy for when a crash starts to happen. Here you can imitate the professionals in order to protect your investments. When a stock market crash starts to occur, as evident in the rapidly falling price of stocks, for instance, or financial institutions going bust, this generally triggers a race. Professional investors will pull their clients' money out of the stock market by converting it into less volatile forms of value. The two most common of these are precious metals and cash. Gold, for instance, spikes in value every time the market is spooked by rumors of a crash, because many regard it as the most stable form of long-term investment. Cash is a close second to precious metals because it generally holds its value even during the most far-reaching crashes, as long as the currency you're holding is backed by a large country like the USA, Japan, or the UK. It's possible for individual investors to follow this example and quickly divest themselves of volatile assets as soon as they see a crash occurring. It's crucial, however, that you know how to do this. Take some time to research how to buy precious metals and make sure that cashing out your shares won't land you with a massive tax bill. That way, when the next crash does occur, you'll know exactly what to do and won't waste precious days in research. There are some types of investments, known as guaranteed investments, that won't crash with the stock market. This is because the companies who offer them are legally obliged to pay out a particular return, even in the event of a stock market crash. The downside of these investments is that the returns on them are very low. This means that most investors won't want to hold guaranteed investments as a large part of their portfolio. That said, having some money in these instruments can be a good way to protect a portion of your assets in the event of a crash. They can also provide a short-term lifeboat for your money as the market starts to crash. For this kind of short-term approach, bank CDs and treasury securities are a good bet. There are longer-term ways to invest in guaranteed assets, though, and some of these offer reasonable returns as long as you're willing to hold them for many years or even decades. Fixed or indexed annuities or even indexed universal life insurance products can provide better returns than treasury bonds and can provide a good income even during stock market crashes. A quick word about debts, which investors often forget about in the chaos of a market crash. If you are holding high-interest debts when you see the market about to enter a crash, you should quickly use any available liquidity to pay them off. This is for two reasons, one short-term and one long-term. In the short term, it's a good idea in times of economic hardship to reduce your monthly outgoings, such as your mortgage payments. Getting rid of your debt also makes sense on a macroeconomic level, though. This is because in the immediate aftermath of a stock market crash, central banks tend to raise interest rates so that financial institutions can recoup some of their losses. If you hold high-interest consumer credit, such as credit cards, these interest rate increases can really hurt. So while it's a good idea to minimize debt even in normal times, it's especially important in the run-up to a stock market crash. Finally, it's important to recognize that you can never be completely safe from a stock market crash. No matter how well diversified your portfolio and how quickly you can get your assets to safety, a broad enough crash will always hurt you at least a little. There are ways of making the most of that though. Specifically, if you're clever about when you accept these losses, you can use them to offset profits in another year, or thereby reduce your tax liability. Tax loss harvesting, for instance, is one option for losses sustained in taxable accounts. You simply sell all of your losing positions and buy them back at least 31 days later. There's no completely reliable way to predict stock market crashes, and similarly, there's no completely foolproof method for avoiding losses that can occur during a crash. What you can do, however, is to prepare for the worst. If you guys enjoyed this video or think it was valuable, then don't forget to hit the thumbs up, subscribe to our channel, and hit the bell icon to get notified first. Also, feel free to let us know your thoughts about the next video in the comments section down below. See you soon. Bye.